Hello, and a very warm welcome to this Master Investor podcast, reflecting on 2022 with myself, Sarah Lowther, and Jonathan Davis, author, investor, podcaster, teacher, editor of the Investment Trust Handbook. You may have seen him speaking at the Mellow events, although other platforms are available, or he can be seen huddled around a game of bridge. Now, Jonathan, of course, this entire podcast could be devoted to your accolades, but it is about 2022. And yes, we are speaking to each other in December, and both of us have quite cleverly decided we would do this in our Arctic coats because it is very chilly. But I want to take us back to June when it wasn't so chilly, and I had a bit of an epiphany at the Small Cap Awards and the keynote speech by Claire Barrett, who's the consumer editor at the Financial Times. And she was saying that retail investors hold the keys to the stock market success. And she was saying, they're not like fund managers chasing top quartile performance. They're being bullied by, top-down management at investment banks. She's saying that the private investor, with their pocket money or pension pots only beholden to themselves, they're the ones that can make or break companies and exchanges. I'm thinking about AIM in particular. And, since June, I think she might have a point. What do you think about the power of the retail investor?
Well, I think you're absolutely right. The retail investor is coming back into vogue, if you like. The retail investor was always a big thing in the markets before Big Bang, before we had institutionalized deregulation of stock markets and globalization, all those good things. Retail investors were the backbone of the stock market. That's obviously changed over the years with the arrival of big pension funds and fund management groups and so on. But the retail investor is making a big comeback, I think, and I think it's a jolly good thing too. I mean, there's a number of factors behind that. One, I think, is simply the fact that the internet now makes all sorts of information available to retail investors that weren't available before. Secondly, deregulation has worked in the opposite effect. It's difficult to get hold of broker research unless you're a client of a broking house. But the information out on the internet is as good as you used to get from a broker, and in fact, in many ways, better than you used to get. So they've empowered the private investor. And then finally, a lot of fund management companies have woken up to the fact that because of changes happening in the market for investment products, they need retail investors. And suddenly both companies and fund managers are starting to bend over backwards to attract retail investors. And that's a really positive thing, provided that investors are smart enough to take advantage of it.
Yeah, and there's a really good article this month, December 2022, released by the QCA.com, which was saying that self-investment retirement schemes, easy-to-use internet platforms, as you've just referenced there, are making the retail investor more powerful. But then there's the platforms themselves, and I've been trying to get my head around this tie-up between Microsoft and the London Stock Exchange. London Stock Exchange has been going in various iterations for the last 300 years. Then you've got Microsoft, which is only 47 years old, established in 1975. Microsoft has taken a 4% shareholding in the London Stock Exchange, the listed entity. And it's a strategic tie-up. So Microsoft, 4% of London Stock Exchange. London Stock Exchange has to pay hundreds of millions of pounds for Microsoft products. So I'm not quite sure where, shareholder perks features in this. And so it buys lots of Microsoft products and then migrates things to the cloud. I got worried because I can remember way back in 2008 when a lot of companies were using certain software, and it almost, as they integrated this certain software from a certain company, it almost broke them. I'm thinking about HP, Whirlpool, Levi Strauss, a couple of companies I worked for, integrating this new software, and it was so buggy, and customers weren't happy. consumers weren't happy, the businesses weren't happy. I just hope that that doesn't happen to the London Stock Exchange. Otherwise, we're going to need to keep our bowler hats on and umbrellas in case there is any fallout from the migration to the cloud. I don't know, I'm a bit concerned about this, but I should maybe stop living in 2008.
Well, I can actually give you an example from even further back, which is that my brother used to be a director of a company called Dorling Kindersley, which publishes coloured, very highly illustrated books, and you can still find them around. And 30 years ago, Microsoft took a stake in them, a strategic stake in that company, thinking that this is very early stages in the internet development of the internet. They were being quite visionary, Microsoft, that they were going to take all these lovely images and books and turn them into things that were available online, which of course you now can do, have ebooks and so on. But that particular thing was, it was ambitious, but it didn't actually do much good for the publishing company. And eventually, after a while, they disappeared. There were too many cultural issues. There were data issues, as you say, all these kind of things. I mean, I think the issue here, as I understand it, is that, Microsoft and the London Stock Exchange are trying to take on Bloomberg, basically. They're trying to give retail investors as well as professional investors. I think professional investors are still the main market, but they're trying to give retail investors access to a data supply service and an information supply service all in one place, which is like a kind of mini Bloomberg. Bloomberg is a wonderful system if you can afford it, but it's £30,000 a year to become a subscriber, to get a terminal. And so I think they're kind of take them on. They only have a relatively small part of that market. But since the LSE took over Refinitiv, or whatever it is, the data system, which used to be known back in the day as, I think it was back in the day, it was Reuters or something, wasn't it, back in the day? They're trying to compete on that level. So yeah, who knows? But the bugs, I'm sure there'll be plenty of bugs, and it will take a long time. They were talking about 2025, I think, before they finally got this all sorted out. So you're probably right to be nervous. And but of course, most people still invest, retail investors still invest through the retail platforms, the Hargreaves Lansdowne's, Interactive Investor, and so on. And they have legacy issues. They will soon have legacy issues, and particularly if you take over other platforms like Interactive Investor has done before they got sold to Aberdeen. I mean, I would have more worries about their technology than some of the other platforms. Having said that, sorry, back in the day, I was a non-exec of Hargreaves Lansdown for a while. And the only thing that kept us awake at night, fantastic business, the only thing that kept us awake at night was the worry that the system would blow up, and the data would, the IT was not really, as wonderful as you would wish it to be.
Yeah, it's interesting you mentioned Bloomberg, that I was a Bloomberg girl, 2003 to 2009. I had a breakfast show on the Bloomberg platform, and then 2008, 2009 happened. They made us all redundant, which I didn't take personally. It made good business sense since no one was buying their terminals anymore. And then Bloomberg had this sort of refresh and rebrand, and they've come out bigger, stronger, smarter, cleverer. So it'd be interesting to see if they are wanting to position themselves against Bloomberg, which is, got a legacy and seems to be kind of sorted. You mentioned
market leader. I mean, I think it's got 80% of the market or something. So it's definitely got, it's the market leader, and has seen off most rivals so far.
You mentioned Dorling Kindersley there. It's a publisher that is very close to my heart, but I've been looking at publishers this week. Penguin Random House, which is a product of Consolidation. It's had its $2.2 billion takeover of Simon & Schuster blocked by regulators. So there's obviously a lot of consolidation amongst the publishers at the moment. So I was looking at the share price of Bloomsbury Publishing, UK listed, known for taking a punt with J.K. Rowling, and then we know what happened with the Harry Potter series. So this particular month, I've seen their share price hitting a year high. And I'm also seeing the institutions building up their stakeholdings within the publisher as well. So, maybe strategic by the institutions looking around to see, could Bloomsbury be a takeover target? But the reason I think that the Penguin Random House acquisition of Simon and Schuster didn't work was an impassioned plea by horror novelist Stephen King, who was completely against the tie-up, saying it's bad for authors. So the power of horror.
Yes, absolutely. Yeah, you're absolutely right. I mean, it has been a huge wave of consolidation in publishing. Been going on for 30 years, I think, actually, going back to the first. It all started. I kicked off in the early 90s, I think, when people actually realized that the world was changing, world of publishing was changing, and the internet's obviously accelerated that. So they're as much defensively driven, I think, as from trying to save money basically by consolidation, and not necessarily good for authors. Exactly. Authors, have a very rough time, as many people know. Most authors, 90% of authors, make virtually no money at all out of writing books. They, I think the average income is about 7,000 a year for an author. It's only the very few at the top who make lots of money out of it, and boy, do they make a lot of money. But I think Bloomsbury is a very interesting story. I mean, they've done really well to. Everybody said, when Harry Potter was started and then blew up, they all said, well, how will they ever repeat that? But they've done a very good job at actually doing that. So I keep an eye on that one as well, and I wouldn't be surprised if they do get a bid in due course. Consolidation, of course, in all these industries becomes a kind of fashion, doesn't it? Investment bankers know a good thing when they see one, and the normal rule of thumb in my case is at least one out of every two consolidations of this kind don't work, basically, and the other half might work, and sometimes work very well. But
so you shared there that most authors don't make very much money, so I suppose it's a labor of love. But you are the editor of the Investment Trusts Handbook. Investment trusts is not a field I know very much about. So in terms of the themes with investment trusts this past calendar 12 months, what moves have been made there?
yes, well, you're very kind of you to mention that. Is actually it's been published. The formal publication is today, the day that we're recording this podcast. So I've got a hard copy. It's landed in my postbox, and so far I haven't found any mistakes in it yet. But there's usually one hidden away in the 268 pages somewhere. But yes, it's been a tough year for investment trusts. Really has been a tough year for investment trusts. But that comes with the territory. We've had a bear market. We've had both stocks and bonds going down at the same time. First time in any calendar year that we've seen a combined decline of 10% in both of those asset classes. We've had a bit of a rally more recently, and that doesn't generally work well for investment trusts, because investment trusts can use gearing, for example, and those that use gearing borrowing to enhance returns over the longer term, they will suffer during a bear market more than open-ended equivalents. And so we've seen both NAVs decline, and we've seen discounts widen. The issue of the difference between the share price and the net asset value is a key metric for investment trust investors, and that's widened this year. But if you're an investment trust investor, that you have to expect that this is what's going to happen. And actually, investment trusts have done quite well over the last year. I actually got some figures from the AIC, and what they told me was, I asked them to look at every investment trust over. There's more than nearly 400 investment trusts out there. There's a lot more open-ended funds, but 400 investment trusts, and of the 300 and something that have more than a £50 million market capitalization, something like 40% of them have actually made a positive net asset value return over the past 12 months, and 20% have made a share price total return. So that means the discounts have widened quite widely. So yeah, it's been a tough year for investment trusts. But of course, that also creates opportunities. If you can buy something at a big discount, you can, when the market turns, make even more money out of them. So yeah, it's been tough, but it's been not unexpected.
So you talk about a bear market there, and about how markets, when they turn. So how many years are we into this bear market, and how long do bear markets normally last for? Because I thought economic cycles were usually 15 years in duration, but then I think everything or the rule book has been torn up over the past 3 years.
Yeah, well, it has. Certainly, we've had the pandemic, which was came out of nowhere, and we've had the war in Ukraine, which few people were expecting. Though in retrospect, you can see that that might have been coming if you had been a criminologist and studied Putin's state of mind. So yeah, bear markets. Well, bear markets come round fairly regularly, but at relatively large intervals. And we have to distinguish between sort of serious bear markets and short-term bear markets. Most people define a bear market in the equity market as being a 20% decline from peak to trough. And if you go past 20%, which we have done this year briefly, the US stock market is down now around, I think, about 16-17%, but it was down more than that at one point. So this is a serious bear market. And there's basically two schools of thought. I mean, they never last for a long time. They never, you won't get a bear market that lasts for more than 2 years typically. So if it started in January last year, which it did do, or even December the year before, when inflation started to get out of control before the Ukraine war, that would suggest that if it runs a typical course, it would be sometime in the second half of next year that it hits bottom, and then we'll see some kind of revival. You never know for certain. Some of them are longer than others. It's all to do partly with the interest rate cycle and what the Federal Reserve is doing. But I mean, a good rule of thumb is, for a bad bear market, 18 months to 24 months. The one between 2000 and 2003 was about a couple of years. It's just over 2 years. But that was a very, a huge bubble before that. So I would have thought something like that, 18, 24 months. The second point, though, is just slightly different, which is the long-term expected returns from here, I think, will be lower than they have been in the last few years, because we're seeing a change in the background of interest rates not being kept very, very low anymore. They just can't do that anymore. So I think we'll be entering a period of relatively lower returns, but we will get back to positive returns quite soon.
And it's at this time of the cycle that people start to deploy unusual marketing techniques. I'm thinking about name changes that make sense. I'm thinking about poor Royal Mail, because, of course, this week we've got train strikes, postie strikes. I think everyone's striking apart from me, but then I am freelance, and if I went on strike, I'd have to negotiate with myself, and I think that's called schizophrenia, Jonathan. So we don't want to. We don't want to go there. So you've got Royal Mail PLC, tarnished with all sorts of problems. So very quietly over summer, it changed its name to International Distribution Services, which is a right mouthful. And has it done anything for the share price? Well, unfortunately, it hasn't. The strikes have cost it about £200 million. I'm not sure if a company can ever recover from that, but waiting in the wings. We talked about consolidation in the publishing world. We've got the co-owner of West Ham Football Club, a Czech billionaire. He's slowly buying up a stake. I think he owns 22% of the Royal Mail parent company, and he might come in, but a new owner doesn't necessarily mean higher wages for the employers. We just don't know. Got to be careful what you wish for, I suppose. New regimes don't necessarily mean more compensation. But that was one name change which I couldn't quite get my head round. I thought International Distribution Services was a really ugly name.
It is a horrible name, isn't it? Yeah. It is a horrible name, shortened to IDS, and that would bring back unfortunate associations with the former Conservative Party leader, Ian Duncan Smith, who wasn't a great success as leader, done some good things since then. You're right, but I mean, I think you can see how the kind of the corporate big cheeses have been thinking about this, change the name, get the attention away from the business that is really struggling, which is delivering post in the UK, and talk about the international business, which is doing quite well. They're quite profitable, I believe. And of course, the whole concept of mail has changed a lot. It's now increasingly about delivering parcels rather than about delivering letters, because we can all use email and so on, and we do, or messaging and so on. So we've cut out a lot of standard letter writing, apart from official bodies, which of course send you in a lot of junk mail about things you don't really want. So it has, the business is changing, so that you can make a rationale for changing the name if the business has changed. But it's not normally a good sign, I don't think. Normally it's an attempt to cover up something rather than, particularly if you go to some really bland name that doesn't have any particular resonation with anybody. I mean, the alternative route is to go for something kind of rather exotic, brandy. And you know, in the fund management world, we've seen this. I think what a number of people thought was a fairly bizarre decision by Aberdeen Investment Management to change its whole name to ABRDN in small letters, no capital letters, purely because I think they thought it might make a better logo or something. I don't know what the thinking was behind it. They must have paid a lot of money for the rebranding ideas that went with it. It's not normally a good sign, I have to say. I mean, I hope that I'm wrong about Aberdeen. They've done some interesting diversification as well, buying Interactive Investor, as we said, or buying a big stake in it. Yeah, it's interesting issue. But normally, if they change the name, you want to be quite worried, I think.
Yeah, ABRDN, it annoyed me on so many levels, but I'm very sort of anti-abbreviation and anti-acronym. There was one name change, though, on the AIM market, which did make sense, and that was Open Orphan changed its name to HVivo. Now, HVivo was one of Open Orphan's subsidiaries. And the chief executive said to me, well, you know, orphan equals rare diseases, whereas the company works with infectious diseases. And he said, I'm not just being pedantic, but the two are very different. He said, Open Orphan served its purpose. We're going to retire that. And by doing so, he said, we save on overheads. You retire a brand, you just concentrate on one brand. HVivo has been around for about 20 years. 93% of the staff work for HVivo. So that name change came in about October, and it's been accepted because it made sense. And if it saves money as well, then, you know, 2 ticks and perhaps a gold star.
Yes, true enough. I mean, there is an awful trend though towards coming up with abbreviations, as you said, which is they tend to obscure things. I mean, going back in the day, you know, British Petroleum became BP because they wanted to emphasize the fact that they weren't just an oil company. Though, you know, what you really want is your name to tell you what the business does, doesn't it? I mean, that's really would be a good thing. Or once you've established a brand name, then, you know, on the whole, you want to stick with it unless it gets totally tarnished by some terrible thing you've done, and you want to change it for that reason. There are quite a lot of examples out there where you had scandals and they then have to change the name so that people don't. They hope that people won't remember that they were responsible for doing something terrible like that. You know, going back to well, distillers, you remember the thalidomide scandal. If you go back that far, it's a long time ago, I know. They eventually got taken over and subsumed by Guinness, which then became Diageo, and then, you know, so on. What does Diageo mean? Does it resonate with you?
Diageo, it resonates with some lost Friday nights. That's about it, really, Jonathan.
Yeah. Okay. Well, perhaps that's not quite the image they want to project, but it's the power.
Apparently,
You can't drink. The point is, you can't drink Diageo, right? I mean, you can't drink Diageo. It's not a brand name you'll see on any of their bottles. It's not like Fever Tree, where you know Fever Tree produces Fever Tree. And obviously they've got so many brands that they can't really kind of isolate one, because that, you know, that will then underplay the other one. So you can see the logic for it. But I mean, you know, the amount of money they spend on coming up with these things that aren't even words, you know, Diageo. Is Diageo a word, or is it named after some, I don't know, some rare thing you take out of the ground to put in your gin and tonic? I don't know. Who knows? Or your Johnny Walker? I don't know.
yeah, no, I don't know. Perhaps we should ask them. But I think that was the problem. It was that I had drank so many of their brands in one sitting, and that's why it was a bit of a lost Friday. But in terms of abbreviations, Jonathan, how would you summarize or abbreviate 2022?
2022. Okay, how would I abbreviate it? Well, from an investment perspective, I would say difficult. That's not, but it could have been worse, I guess. I mean, the thing about this year, 2022, I mean, COVID was terrible. the pandemic was terrible, a terrible human tragedy, as well as a real threat to the global economy. This year we've had Ukraine, and I don't think you can therefore make 2022 a positive year. And you don't want to associate it with a positive abbreviation. I think it's been a terrible development, and who would have thought? I mean, I mentioned this in the Investor Trust Handbook, the notes I write. I mean, who would have thought this year that we would have seen both the return of double-digit inflation and a war on the continent of Europe? I mean, an invasion of another country on the continent of Europe. I mean, those are two things that back in, not so long ago, we thought we would never see again. Inflation, because they've been controlled, we knew how to control them. Unfortunately, central banks and governments have let that get out of control. And war in Europe, because that was just unthinkable. We thought we'd, if you triumph of democracy and all the rest of it, the collapse of the Soviet Union, we thought the development of the EU, the NATO umbrella, we thought we would never see that again. And it's a really horrible development that may yet, though, produce a positive outcome. So I think, I guess I'd say difficult, but not without hope.
Which leads me to my final question, which is 2023. Will it be more civilized?
More civilized? Well, it can't be more civilized than you and I having this conversation, I suppose we could say that. Yeah, I hope so. I mean, I hope for good outcomes on both measures, both those two things anyway. But there's no doubting we are facing a very difficult next few years, I think. I mean, governments are over indebted. We haven't seen the end of the Ukraine war, and there is talk of a negotiated settlement, but will that be a positive? Hard to say. Where things happening in China that are alarming, and so on. So there's always things to worry about. But basically, if you are a human being, and certainly for an investor, you have to have an optimistic streak, because that's the reason you invest. And I'm definitely one of those who are in the positivist camp, that the human race is extraordinarily good at fixing problems. I mean, I haven't mentioned climate change. Obviously, that's a long-term problem to be dealt with. But we do have a long record of actually solving problems, provided we can all work together. And that's obviously what we all hope will happen this year.
That's one of the things I love about you, is that your glass isn't just half full, it's always full, Jonathan. And I really look forward to speaking to you next year, when hopefully it will be a bit more civilized and maybe a bit warmer. And this coat smells a bit damp actually, so I think I'm going to have to put it back in the airing cupboard. But it's not smell-o-vision, thankfully. And thank you, Jonathan.
Well, let's hope so. And I should mention that my glass will be more than half full of Diageo products in the next few days. So at least that will be some consolation.
Take care. Thank you, Jonathan. Cheerio. Merry Christmas.
Pleasure as always, and happy Christmas to you.